Potential investors might be feeling a little bit trapped these days. Even if there are great deals, you might not be able to qualify because interest rates are going up so much. If you're feeling stuck, you'll probably want to understand what goes on with mortgage qualifications so that you can figure out ways to change things up. And if you're just starting out, this video might be even more important to you so that you can figure out the best roadmap for long-term success. So stay tuned where I'll walk through the most common mortgage problems that investors run into and how you might be able to restructure things to improve your total borrowing capacity. But before I continue, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you can see more videos like this made specifically for real estate investors in Toronto. The most basic way that banks look to qualify you for mortgages is to see how well you can pay for your expenses and mortgage payments stacked against how much you make, and there's two main ratios to look at. The first compares only the payments on the property you want to buy. The second one is usually the tougher one, which looks at all of your existing debts and payments plus the new property stacked against your income. These ratios typically need to be below a certain percentage before the banks say okay to lend money to you. And so, if you want to maximize the amount that you can borrow for investment properties, the basic concept is to improve your income and reduce your debt. Honestly, the top reason that most people are stuck is because they are front-loaded with debt on their own home. Of course, an expensive home is nice, and I can't say it's a bad decision, but it does mean that it does take up a huge chunk of your qualifying income. And unlike rental properties, it doesn't give you extra income to balance out your ratio. Take a look at this example. If you have an income of $200,000 and you have a $1.3 million mortgage on your home, you will end up being completely maxed out on your mortgage ratios, which means you won't be able to borrow any more money for a rental property. On the other hand, if you only take on a $700,000 mortgage on your own home, then you would be able to qualify for another $700,000 mortgage on an investment property because it also generates rental income to help with your ratios. And so, if you compare the two, your absolute appreciation ends up being higher in the second situation because your total property value is bigger. You also get rental income and you have better cash flow. So all in all, it ends up being a better financial decision if you choose a smaller home to live in. If you already own your own home, but you want to qualify for a bigger purchase on your next investment property, selling your own home and buying a smaller one might not be the best idea because you will be hit with an extra set of land transfer taxes and selling fees, and you might end up with a higher mortgage rate these days. But here's the thing, your own home doesn't need to be dead weight. If you are willing to rent out part of your house, then it can turn into an income-generating asset and improve your ratios. Here are a few examples. If you rent out a one-bedroom basement in Toronto, you can get around $1,600 per month in rent today, and that's almost $20,000 of extra income per year, and so that can improve your borrowing ability by $100,000. A two-bedroom basement will bump this up even more, and if you want to go even more extreme, you can really maximize the rental space in your home in Toronto if you add a laneway suite or a garden suite in the back. If you do that and you rent out your basement as well, that's probably the best way for you to improve your mortgage ratios. A backyard two-bedroom home can rent for $3,400, plus you'll get an extra $1,600 in rent for your basement apartment. This is an extra $5,000 of rental income per month or $60,000 per year. And so this is probably one of the best ways to balance out the debt on your own home and help you qualify for bigger mortgages on future investment properties. Here's another situation that we sometimes see. Investors would have their own home and they'd also have a condo investment. And because condos don't cash flow as well, it makes it hard to qualify for another big mortgage after that. Take a look at this example. Let's say you own a home that you've been paying down, and so you currently only have $500,000 of mortgage on it. you also own a big condo rental property which has a $700,000 mortgage and gives you $3,800 in rent per month. In our current market situations, you can only qualify for another $600,000 for your next rental property, which ends up limiting you to condos in Toronto. If you had a house rental with a similar mortgage as your first condo investment, you could actually get much better rents at $5,000 per month. So this extra $1,200 per month in rent bump would actually be the difference that can help you qualify for another $700,000 mortgage, and the difference between being able to invest in a house instead of a condo next. The big difference between investing in a house and a condo, however, isn't just about asset value and rental income. It might also end up being the difference between qualifying for more mortgages in the future. For example, there's some programs where banks will qualify you based on how well your existing investment portfolio cash flows without looking at your principal residence once you have enough properties. In this case, you will more likely qualify for this program with investment properties that are houses because they do cash flow positive, and this program is usually a no-go for condos that cash flow negative. Here's another thing to keep in mind. If you're looking to diversify your investments and eventually have condos and houses in your portfolio, the best way to do it is to start with better cash flowing, bigger properties first, which ends up giving you more weight with better rent yields earlier on. And so banks will be more willing to lend you more money, and then eventually you can save those smaller purchases for condos less because they're probably going to slow you down from borrowing more money in the future. And finally, let's talk about repositioning assets. If you already own a condo investment, you might be in a tougher spot because selling your condo and buying a house would mean you're getting hit with an extra set of fees, land transfer taxes, and capital gains tax earlier. I think in this case, you should be thinking about how long you'd be holding your investment for and whether you'd be looking to grow more beyond this point. If you want to buy more properties and have stronger cash flows and holding power in the long run, it still makes sense to make the switch. And it's probably a better idea to switch sooner than later. If you're looking to buy investment properties, the first step for you is always to figure out how much you can borrow. Not all banks are the same, and some banks and mortgage agents are definitely more investor friendly. So if you need help getting started with real estate investing, we'd be happy to put you on the right track. We're a real estate sales brokerage that focuses on investing in real estate in Toronto, and we can start off by taking a look at your existing situation, help you figure out what's best for you, and point you to the right lenders to get things started. Once you're ready to buy, we'll show you different opportunities from a numbers, time, and work commitment standpoint, which can help you make better investing decisions. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.